So we haven't really talked about this yet, and this is one of the actual major issues in financial markets we're going to discuss in this in this couple of videos we're going to have now. And really the focus is on market failures. We have discussed market failures a couple of times already. In particular, we talked about public goods and why the financial markets in general are a public good. And so we're going to be going back to that issue now, discussing alternative types of market failures. And a market failure is just basically a scenario when markets function poorly or inefficiently if left alone. So in other words, a market failure exists when a market operates in a fashion that hurts people in the market unless the government gets involved, okay? So most markets do not have significant market failures, so you can basically just leave them alone, let them function however they want, and it'll be totally fine, okay? So like the market for plastic cups is probably a market that doesn't have significant market failures, okay? So you can basically just ignore it from a governmental standpoint. Interestingly, however, financial markets are basically filled with market failures, which means that there are significant arguments for having the government or some sort of similar body like the Federal Reserve to be involved. And that's kind of the reason why we have this class, is basically to go through all the problems that financial markets have and to understand why it's something that needs to be regulated, studied, why you need a central bank at all. All those questions are basically answered because of the market failures, okay? And we've seen this throughout the class. Just as a fairly recent example, we talked about how China keeping their currency devalued basically led to surging housing prices and ultimately a collapse of the U.S. economy back in 2008. So just the action of one person has the ability to affect other people that are completely not involved at all with that choice to keep their currency devalued. That's a type of market failure, okay? So I'm going to go ahead and define a few terms just to get us started here. If you've taken other economics classes, you probably have seen this before, probably, okay, depending on which ones you've specifically taken. But asymmetric information is a nice, simple idea. This is when one side of a transaction knows more than another. And this is really common, right? Asymmetric information is extremely common. So you can basically think of it this way. Every single time you go out to a restaurant, you don't really know how good the ingredients are today. You don't know if there's a mouse running around last night. You don't know if the cook washed their hands, right? So there's significant asymmetric information. The restaurant knows more about their current quality of food than the customers do, right? And this is just a very common problem. If there is asymmetric information, there is also sometimes the following, okay? So generally speaking, asymmetric information is a necessary but not sufficient condition for the following. So in other words, if you have asymmetric information, that allows for the possibility that you'll run into one of these two issues, okay? One of these issues is called adverse selection, and the other is called moral hazard, okay? I'm going to try to define these here, but to be honest with you, the explanations and the examples are way more useful than the definitions, okay? But let me go ahead and give you the definitions just to try to give you a starting place here. Adverse selection occurs when one side of a transaction, so for example, if you're going to a restaurant, there's the buyer, there's the seller, right? So one side of the information has more information and they take advantage of that. So this is when one side of a transaction uses their extra info in a way that harms the other party. Okay? So for an example of this in the restaurant industry, and this is maybe not such a great example, but you know, if you're a restaurant, maybe you got a bunch of leftover fish that you haven't been able to sell because it's not very good, all right? The issue there is if you've got a bunch of leftover fish, that fish isn't really worth very much. But if you're the restaurant, you're probably going to serve fish tacos today, right? You're going to take advantage of the information you know, which is the fish isn't very good, in a way that harms the consumer who doesn't know that the fish isn't good, okay? And this could harm the consumer because maybe the fish is actually going bad and you could become sick from it, all right? So this is the business taking advantage of their information that the customer doesn't know. That's not a great example because if you get sick from going to a restaurant, you probably won't go back again. These are most damaging when the other person has no way of knowing that is going to happen, okay? So for example, let's say that I've got a car that I'm trying to sell. I've got a used car, all right? In fact, I do. I have a Nissan Versa I'm thinking about selling. 2014 Nissan Versa. If that car really sucks, like if it's got a lot of problems with it, I'm more likely to sell it, right? Because I know it's bad, so I want to get rid of it. And the problem is the buyer doesn't necessarily know if my car has problems or not. And it may be a long time before they find out if it does, okay? So if I take really poor care of my car, if I don't get all my oil changes, if I notice there's a sputtering sound that happens only in the winter, I'm more likely to sell my car. So that creates significant adverse selection because that means as a buyer, when you buy used cars, the market has a lot of really crappy used cars available for sale. Because think about it on the flip side. If I have a really good car, why would I sell it? All the market, all the consumers out there know that there could be a lot of crappy cars for sale. So if I sell my good one, I'm going to get a low price for it because people assume it's problematic. So again, what ends up happening is when you try to buy a used car, the market is filled with lots of really bad ones. That is part of the reason why cars devalue very quickly. You know, you probably heard this. If you buy a new car, it loses its value almost immediately. That's because people who resell a car very quickly after buying are way more likely to have a lemon than someone who keeps it, okay? So that is an example of adverse selection, all right? One thing to note about this, which might help you separate adverse selection out from moral hazard, is this happens before the transaction. In other words, adverse selection is something that happens before the transaction occurs. So for example, when I'm thinking about buying a used car, when I go buy the used car, before I've even done it, I'm already at a disadvantage because the market is filled with crappy cars, all right? Therefore, I'm going to have a tough time selecting. I'm going to face adverse selection when it comes to buying a car. Similar to that, there's also a moral hazard. Okay? Cinco's not happy about moral hazard. Cinco, shut up! Okay, moral hazard is this. This is when one side of a transaction changes their behavior, usually as a result of how the transaction is structured. Sorry that I'm running out of room here, but we're almost done with this couple terms. Let me just give you a second to write this down. This is when one side of a transaction changes a behavior, usually as a result of how the transaction or contract is structured. And their new behavior hurts the other party. When one side of a transaction changes a behavior, usually as a result of how the transaction or contract is structured, and the new behavior hurts the other party. These can be kind of tricky to separate out, but what I do in my head to help me understand which is which here, okay? Remember we said adverse selection is before the transaction, so it's thinking about who chooses to enter the market. Moral hazard is about after the transaction has already occurred. So this is after the transaction. And let me give you an example to kind of explain here why this is relevant and how this would work. All right, so let's say, for example, that I'm going to teach a class at 8 a.m., okay? So I teach a class at 8 a.m., and I'm going to get paid the same regardless, okay? So what I really get out of teaching is I feel a lot better when students learn, right? When students learn, that makes my job much better. I would gladly be willing to pay $5,000 a year to get all my students to try 3 times as hard, because it just makes my job way better, okay? So let's imagine in the fall, turns out I have to teach an 8 a.m. class, which is true. I am teaching an 8 a.m. class in the fall. Let's think about why that's going to be problematic, okay? I want all of my students to try hard. I want them to work hard. I want them to be smart, okay? The asymmetric information is I don't really know how smart or how hardworking the students are going to be that come into my class. There are ways we try to deal with that problem. We try to use SAT scores, ACT scores, GPA, but all of those are flawed, right? None of those perfectly show how hardworking a person is or how smart they are, all right? So if you give me an 8 a.m. class, there's going to be a couple of problems. First of all, the students who take my 8 a.m. class are usually people who signed up at the last minute. They're lazy. They didn't want to get prepared and actually go in and register. They didn't want to wake up early in the morning to register for classes, you know. So you're going to get adverse selection just to begin with. In other words, the type of person who takes an 8 a.m. class is already not a very good student on average, okay? What's funny about 8 a.m. classes is there's usually 2 groups. There's ones that are like really bad students, and then there's ones that are really good students. They're like waking up early and everything and ready to go. But generally speaking, if I see I got an 8 a.m. class, I'm like, damn it, that sucks, because I know it's going to not go very well. People are going to be showing up late. They're not going to be trying, okay? So part of the reason there's a problem is the adverse selection. The type of student who takes an 8 a.m. class is generally less motivated, okay? That happens before the transaction. Before we even start the class, I already have a bad group of people, okay? But there's also moral hazard, okay? And the moral hazard is this. Once they begin the class and it's at 8 a.m., the fact that it's at 8 a.m. actually makes them a worse student because they're coming in late, because they're tired. You see, there's a problem to begin with. If I had the same students for my 8 a.m. class, if my class was at 11, I would still have had the adverse selection, if we can imagine I had a bad group, okay? But the moral hazard would go away. If I could somehow move my 8 a.m. class to 11 and keep the same students, they would still not be good students. I still have adverse selection. But the moral hazard would go away because students perform well generally at 11 a.m. That's kind of like right in the wheelhouse of when I get the best students, okay? So by having it at 8 a.m., I get a bad group of students, and because it's at 8 a.m., they act even worse, right? So the adverse selection is, who is my student? Bad ones. And the moral hazard is, they become even worse because it's at 8 a.m. So what you'll see is a lot of times you get both adverse selection and moral hazard at the same time. Let me show you an example in the financial world. Okay, so let's look at an example now in financial markets. Let's think about a company that's considering going public, considering doing their IPO, right? IPO stands for Initial Public Offering. That is when a company issues stock and become publicly traded, all right? So let's imagine you have 4 owners of a firm. They each own 25% of the company, and they're trying to decide whether or not to go public, okay? We could probably come up with a lot of different examples of asymmetric information, but the one I'm going to refer to here is thinking about the value of the company, okay? Who knows about this firm more than anyone else? Probably the owners, okay? So let's think about the owner's perception of the value of the company, okay? The owners perhaps have a perception that the company is worth $100 million, okay? So this company right now should be traded at $100 million total, okay? Now they could be wrong, but the thing is they probably have a better feel than the public, all right? So they hire some people to go out there and get a perception from the, do surveys to try to figure out what the public views of them. And what they find is the public perception is that this company should trade at a total value of about $50 million. That their market cap should be about $50 million. In this case, if you're the owners, would you issue stock? Okay, keep it in mind, when you issue stock, you're only able to raise funds on what people are willing to pay. So if you issue stock right now, what this basically tells you is the public is only going to pay 50 cents to the dollar in terms of what you perceive as the company's value. So definitely, you're not going to IPO. All right? Anytime the public undervalues your company, doing an IPO is not going to make sense because you're not going to be able to raise the funds that are worthwhile. Really, what an IPO means is these owners would have to sell off some of their shares, right? And they don't want to have to sell off shares when the public is undervaluing their company. On the contrary, let's imagine in a second scenario here that the owner's perception is still $100 million, but the public perception is that the company is worth $200 million. Now, what this means is that doing an IPO makes a lot of sense. The company is overvalued by the public, which means if you're one of these 4 owners, you can sell your shares and get $2 relative to the $1 that you think each of your shares is worth, for example. Okay? And so definitely you're going to want to IPO. Does that sound like adverse selection or moral hazard? That is adverse selection, okay? Before the transaction being whether or not to sell shares, to IPO, before that occurs, the types of people and the types of businesses that will IPO are the ones that the public overvalues, okay? So the adverse selection here is the IPOs are only going to be done by companies that are overvalued by the public. So that means that when it comes to buying stock, kind of like you would get a lemon if you try to buy a used car, kind of like you get bad students taking 8 a.m. classes, when companies IPO, we can expect that you'll have a high proportion of those companies that are really overvalued, okay? And the problem is there's really no way to test this. We talked about this in prior videos. There's no way to tell what a company's real market cap should be. So there's no real way to see that this is happening or not, okay? Okay, so that's the adverse selection, but that is not the only problem. There's also some moral hazard. So remember, moral hazard is how one side of the market, the side with more information, changes their behavior in a way that harms the other side, okay? So after the transaction, after the IPO, maybe what happens is rather than having 4 owners that own 25% each, you have the 4 original owners that maybe own 1% each, and then you have the public that owns 90% of the shares, 96% of the shares, right? So you got 4 owners at 1% each. Maybe the company's value, as we said before, the value is known to be $100 million, okay, in terms of what the original owners believe, okay? So these 1% shares are worth $1 million in their eyes, kind of on a long-term basis, okay? So let's think about this here, okay? If you're one of the 4 original owners, before the IPO, if the company fails, you lose $25 million, right? Because originally you own 25% of the company. You perceive that the company is worth $100 million. So if the company fails entirely, you lose $25 million. Okay, that's the way you would think about it if you're one of these co-owners. Now, after the IPO, if the company fails, you only lose $1 million, which is still a lot, right? But it's 4% of what it would have been prior to doing the IPO. And the thing is, these original 4 owners probably have leadership positions in the company, right? These might be the CEOs or CFOs of the company. This is going to create not such a great incentive, okay? One incentive here is to work less hard. Now, you might be thinking, why would you work less hard? You still own $1 million. Well, think about incentives, okay? What we have basically done is change up the incentives. If the company fails, that doesn't hurt as bad as it did before. And likewise, if the company does great, that doesn't help you as much as it did before, right? If this company doubles in value, you would gain $1 million. Before the IPO, you would have gained $25 million in extra profit if this company's value doubled. So your incentives are weaker. And furthermore, the second incentive is you probably take more risk. Okay? Because now, after you've done your IPO, if the company fails, you lose $1 million. Okay? If the company gains, maybe it doubles in value, right? You would gain $1 million in new dollars, in marginal dollars. And then also, you'll probably get some other offers from other companies. So if you're the CEO of this company, you're thinking, look, if this company fails, yeah, I lose $1 million, okay? But if the company doubles in value, not only do I get $1 million, but I also get offers for other businesses, okay? That may have been true before the IPO as well, but remember then, you would have lost $25 million if the company fails, all right? In other words, the benefit of this offer is larger when we're dealing with a company like this, okay? If this offer is worth $5 million, $5 million wouldn't have felt like a big deal when we're starting with $25 million in value. But by shrinking down the value of the gains and the losses, the offer now has a bigger relative pull, okay? So if I'm the CEO of this company and I view the potential of getting extra offers at being worth $5 million perhaps, then basically I'm going to be super risky, okay? If I've got something where there's a 70% chance my company will fail if I do this deal, but a 30% chance that my company is going to skyrocket if it does well, I'm going to do that deal, okay? Because not only will I get more money if the company does well, but I'll get a lot of money from the other offers, okay? So, after an IPO, companies tend to be more risky, which is moral hazard, okay? Changing their behavior after a transaction in a way that hurts the other party. The other party being your shareholders. Your shareholders don't want you to take unnecessary risk. But now as a CEO, I'm incentivized to take risk because I lose less when there's a failure. And because I think more about the alternative options out there if my company does well. Now, with the second market, let's think about borrowing money, which is really just issuing bonds, okay? So we saw stock markets and how you see you got asymmetric information, adverse selection, moral hazard in that market. You're going to see the same types of problems in the bond market, okay? Just to give a really simple example here, let's think about two borrowers, Greg and Alyssa. They both need to borrow $100,000 for some reason, okay? The reason isn't important. Let's think about the asymmetric information first. The asymmetric information is that I don't know how risky these people are. Now, we have ways to try to improve asymmetric information, and this is true in basically all markets. All markets have tried to figure out a way to improve asymmetric information, okay? When it comes to the used car market, you've got Carfax, right? They try to give you information about the vehicle. When it comes to borrowers, you've got credit scores, which tries to give you an idea of how risky the borrower is. But none of this stuff is ever perfect, okay? There's always going to be some asymmetric information in a deal like this, all right? So let's imagine that I offer an interest rate of 4%, and I'm choosing just between these two borrowers. I've got $100,000 I want to lend out, and I've got two borrowers here, and I'm going to lend the money to whoever's willing to pay more, okay? If I do 4%, both of them say they want to do it, okay? And I say, well, okay, if you both want to do it, it's kind of like an auction. I'll just keep raising the rate until one of you doesn't want to do it, right? And so eventually what happens is, as I raise the rate up, at 8%, Alyssa decides she doesn't want the loan, and so I get Greg. Right off the bat, let's think about why Greg would be willing to pay more than Alyssa, okay? Why would Greg want to take this loan at 8%? There are a few possible examples, okay? Maybe no one else will lend him money because he's risky, right? When that rate got up to 6 or 7%, Alyssa said, never mind, I don't want to borrow the money, and she went and borrowed from someone else, okay? The very fact that Greg is willing to pay 8% means no one else is willing to lend to him at a lower rate. So maybe he's risky, and that's why he's willing to take my loan. maybe even more aggressively than this, maybe he has no plans of paying back. If you don't have any plans to pay back a loan, it doesn't matter what the interest rate is, right? If the interest rate is 1,000,000,000%, who cares? You're getting $100,000 now, and you're not going to pay back the interest anyway. So who cares what the interest rate is, all right? So if I offer a high interest rate loan, the higher and higher I go with the rate, the more and more I'm going to get people that are bad because they're risky, okay? Or maybe a third possibility. Maybe they just don't understand interest rates. And that's why they're willing to do an 8% loan, okay? If they don't understand interest rates, probably they're risky. Probably they don't understand finances very well, and they're likely to make mistakes, okay? So here's the thing. When you lend money to people, you're generally going to get people that are unlikely to pay you back, all right? The very fact that they want to borrow means they don't have the money, right? In other words, if there's somebody who has $5 million just sitting in a bank account, if you lend them $100,000, they will pay you back. But the problem is they're not going to borrow from you to begin with. So the type of person who is going to borrow from you is the type of person who doesn't have a lot of money and therefore will have a hard time paying you back, okay? And we can kind of boil all this down into the default risk. The problem with Greg and Alyssa is we really don't know their default risk. So for Greg, maybe the default risk is 20%. And for Alyssa, the default risk is 1%, okay? What this means is, even at an 8% interest rate, I shouldn't be lending to Greg because his default risk is 20%. So I'd actually be better off going back to 4% and loaning to Alyssa at that rate. The problem is I don't know these default risks in reality, and I don't have any good mechanism to decide what sort of interest rate to charge different people, all right? That's not the only concern here, though. There's asymmetric information. I don't know about people's levels of risk. There's adverse selection because the people that are willing to borrow are probably the ones less likely to pay me back. But there's also moral hazard. And the moral hazard is this. When I charge a high interest rate, the borrower will have a harder time paying me back. So this is why loans have moral hazard, okay? So you can think of it this way. Let's imagine this is just a one-year loan that we're talking about, right? A one-year loan for $100,000 like we've been discussing. If I do a 4% rate, then the interest plus the payments plus the premium or principal, okay, is $104,000, okay? Which is going to be hard for somebody to pay back. But if I offer a higher rate, now the interest plus the principal is $108,000, and I can continue on with this. Maybe if I take this to 100%, now that means a $200,000 repayment is required. So here's the problem. When you charge somebody interest, it makes it increasingly harder for them to pay you back. So if there is somebody who is risky to begin with, that's the adverse selection, okay? If there's somebody who's risky to begin with, they're already unlikely to pay me back. But when I tack on an 8% interest rate, that makes it even more unlikely that they don't pay me back. Because the higher the interest rate is, the harder it is for them to maintain the funds to pay me back, okay? So if I charge somebody a 1,000,000% interest, they'll never pay me back. If I charge them a 0% interest, they might pay me back. But the problem is, how do I charge people then? How do I decide what interest rate to charge to people? Normally what you would say is, to make more profits, you charge people more. But in this market, the more you charge them, the more likely they are to default, okay? So just to make sure we understand what we've got going on here, okay? First of all, we've got asymmetric information, which is we don't know how risky people are. The adverse selection is when I make loans to people, the types of people who want to borrow are the risky people. And the moral hazard is after they're in the transaction, they become even less likely to pay me back because I'm charging them interest. The interest actually discourages them from paying it back, So you get adverse selection and moral hazard, okay? And what's always interesting with these types of cases is there's no clear solution, okay? You might be thinking, just charge them less interest. Well, charging them less interest might help, the adverse selection and the moral hazard a little bit. But the problem is when you charge less interest, that means your profit margins will be smaller as the lending company. You might think charge them higher interest, charge them more. But the problem is the higher and higher interest rate you go, the fewer and fewer illicits you get, and the more and more Gregs you get that are borrowing from you. So there's no clear way to figure out how to fix this problem. And that is what makes it a market failure, is there's no clear solution. It's usually at this point that some students wonder, why even have the distinction between adverse selection and moral hazard, because it seems like they tend to happen at the same time. And I just want to point out that there are examples where you have one without the other, okay? So, for example, let's say that I make a new policy right now for our class, and I say your test 3 grade can be dropped if you want, okay? So in other words, if you take test 3 and it brings down your overall average in the class, you can just take it out of your grade, okay? This is not going to cause adverse selection because there is no selection occurring. The people that are in the class are already in the class. So there's no way for me to change the type of student that's in the class, you see? But what it does do is it causes moral hazard. Specifically, it causes students to study less, which is not what I want them to do, okay? So it hurts me, the other side of the market, okay? So that is moral hazard without the adverse selection, okay? You can also have examples where you have adverse selection without moral hazard. This is probably true for buying a used car. The adverse selection is the cars for sale are lemons. Hopefully you've heard that term before. A lemon is just a car that breaks down a lot. It's low quality, right? So because people are unlikely to sell their car if it's working really well, and they're more likely to sell a lemon, the market tends to have lemons, okay? We've kind of gone over this already, but if consumers know that there's a good chance a car is a lemon, what they're willing to pay for a car will be relatively low. So if I have a really good car, I'm not going to sell my car at a relatively low price. If I can somehow convince consumers that my car is good, they'd be willing to pay what it's worth, but it's really hard to convince people of that, okay? Because you have the information as the seller that the buyer doesn't have. This is adverse selection because the types of cars that are selected to be available for sale tend to be of lower quality than those that aren't available for sale. But there's no moral hazard, okay? Once you buy a used car, it doesn't change your behavior in a way that hurts you or hurts the other side, okay? So once the selection takes place, the transaction's done, the problems basically have been finished, okay? So you can have one without the other. Okay, so let's talk about insurance. We've not talked about insurance the entirety of this class, and insurance is a type of financial market, okay? And we're going to talk about it now, and basically what you're going to learn is the insurance market is just filled with problems. Basically, every single market failure that exists is evident in the insurance market. So as an example, we could really choose any market here, but let's do health insurance, because obviously that's a really important market. I don't like talking about health insurance too much in my classes because I figured that students know a lot about health insurance a lot already because they're getting it from other classes. But let's talk about it here just a little bit, okay? First of all, when it comes to health insurance, the asymmetric information, of course, is that the customer knows more than the firm about their own health, okay? So I know more about my own health than the insurance company does, okay? So just to give you a very obvious example of this, when I had, I usually don't have dental insurance, but I went to the dentist and they told me I was going to have dental surgery. So the next year I got dental surgery and I had insurance for that year. So I signed up for dental insurance for a year, got the surgeries and everything. And then after that year, I got rid of my dental insurance, okay? So that's the asymmetric information turning into adverse selection. the adverse selection is the sick people, the risky people, the sick people, they're the ones that have the most to gain. From health insurance. So, if a company is going to start selling health insurance, the problem is, if you set the price at, let's say, $50 a month, and let's say this is really good health insurance, okay? If you set the premiums at $50 a month, you're going to get lots of people wanting the health insurance, okay? So you're going to get lots of consumers, okay? I would pay $50 a month for health insurance, right? If it was really good health insurance, I bet you would too. So basically the problem though is, of course, that if you're a business, health insurance firm, and you charge $50 a month, you're not going to be able to make a profit, okay? There's no way to turn a profit on that cost. So what you would need to do is raise the price. So maybe you go to $200 a month. The problem is for health insurance, if you go to $200 a month, you lose the healthy people, right? All these consumers that would have been willing to have health insurance at $50 a month, the ones that are not willing to do it at $200 a month are the healthy people. If I know I very rarely get sick, I'm not going to be willing to pay $200 a month for health insurance. On the other hand, you're going to retain the risky and the sick. So by nature, since sick people get more out of health insurance than people that are safe and not sick, okay? The customers you get as a health insurance company are naturally going to be bad customers, the ones that require a lot of medical care. And if you raise the price even further, let's say to $5,000 a month, now you're only going to get the very sick. The people who have cancer, the people that are extremely risky, they're going to be the only ones that do this, okay? And these companies, of course, have ways to try to improve the situation. They charge different prices based on age in a lot of cases. They charge different prices based on whether or not you smoke cigarettes. But of course, there is no perfect way to fix this. There will always be adverse selection. But that is not the only problem. In this market, like a lot of other ones, we have adverse selection and moral hazard. So let's imagine that you're one of the customers here that signs up for $200 a month. You go from having no health insurance to having really good health insurance, okay? What this is going to cause you to do is take more risks, because you know that if you get in a medical accident, for example, you are partially covered, okay? Now, getting sick, no one likes getting sick, but this is going to cover your cost, your financial cost if you get sick. I actually went like 2 months without health insurance one time, and I was really scared. I drove less. I didn't go do risky things. And then right after I got health insurance, literally the next day I went skiing. That is moral hazard, okay? The moral hazard is people take more risk because they have health insurance. And if you've ever gone without health insurance, you might not realize it, but we do know that people do take less risk. So we can actually look at their behavior, okay? So the adverse selection is sick, risky people have the most to gain from insurance, so they're the ones most likely to buy it. And the moral hazard is people are riskier with insurance. Once they get health insurance, they act riskier, okay? So you get both the adverse selection and the moral hazard, and it's really hard to fix this problem because, as I said before, if you raise the price, you just get worse and worse people. So there's no clear way to fix this. This is not the only problem. All right, so we've already got two very key market failures there, adverse selection and moral hazard, but that's not the only one. Let's say that I get in an accident and I'm on this health insurance plan, okay? If I get in an accident and it costs the health insurance company $100 million, let's imagine it's this amazing accident with all these incredible complications, and to fix me, it costs the insurance company $100 million, okay? Well, this is a big hit for the insurance company, so what are they going to do? They're going to have to raise premiums, all right? When people are getting sick more often, that hurts other people that has health insurance, okay? So for me, who's sick or hurt, my premiums go up. That's okay because I'm the one who got sick, right? My premiums might go up 10%, but that's still sure as hell better than trying to pay $100 million out of pocket, okay? The problem here, though, from a market failure standpoint, is the people who are well, that didn't have anything to do with my accident, their premiums go up too. And so what this means is there are significant externalities associated with health insurance, okay? An externality is when actions taken by anyone hurt or help bystanders. And I know we've defined this before, so I don't have to spend a whole lot of time on this, but for example, you know, if you've ever been out downtown or something and there's somebody smoking a cigarette right next to you, that's probably a negative externality for you. You don't like the fact that you're going to smell like smoke, but there's not really anything you can do about it. You're a bystander, okay? Same deal here. Somebody who is well has no control over me. But if I go out there and take a bunch of risk and drive a car really fast or something and get in an accident, their health insurance premiums go up even though they had nothing to do with me, okay? So there are externalities. In that case, that's a negative externality, but there's also positive externalities, okay? If I just stay at home, that means I'm way less likely to get sick. That means I'm way less likely to get in an accident, which means over the long term, because of me, everyone's premiums will go down a teeny tiny little bit, all right? So there can be both positive and negative externalities from this type of action. We're still not done with all the market failures. We've seen adverse selection, moral hazard, and we now see externalities, but that's not all. There are also public goods. Remember, a public good is non-rival and non-excludable. We definitely spent a lot of time on this. Non-rival and non-excludable. The non-rival part means that when you enjoy or consume the benefits, they don't go away. So a sandwich is rival. If I eat a sandwich, no one else can have it. It's rival. When I eat it, it's gone. But if there's a really pretty sunset and I look at the sunset, that doesn't affect anyone else's ability to do it. I can consume the good sunset, but someone else still can. It's non-rival. Also, things can be excludable or non-excludable, okay? Non-excludable means there's nothing you can do to stop them from enjoying it, all right? In the case of health insurance, let's say that I get a flu shot. This will not only affect people that are on the insurance, it will affect everyone. It will affect all insurance premiums. If lots of people get the flu shot, that will drive down all health insurance premiums. But the problem is, there's not much the health insurance companies can do about non-customers, okay? They can incentivize you to get a flu shot, and they actually do, right? If you have health insurance, you probably know this. A lot of times, companies will give free flu shots, okay? Basically, if you don't get the flu, you're cheaper for the health insurance company, all right? And so they'll actually cover your flu shot so that you'll get one, pretty much on any type of health insurance plan that I've seen. And there's actually some cases where they will pay you to do this. The health insurance will pay you to get a flu shot because that is a good payment for them because it drives down your overall medical costs, all right? So from an individual standpoint, when you think about a health insurance company, they can pay people to do that. It's not really a public good. But what makes this a public good issue is anyone who gets a flu shot helps the health insurance company, even those that aren't consumers, okay? If you get a flu shot, that makes me less likely to get the flu. And that benefit is non-rival and non-excludable. In other words, if you get a flu shot and I don't get the flu, that doesn't mean other people also don't get that same benefit. Me not getting the flu, right, doesn't mean that they are more or less likely to get the flu, right? It's non-rival. In fact, if you get the flu shot, that reduces everyone's likelihood of getting the flu, okay? That's what makes it non-rival. It's also non-excludable. There's nothing I can do to stop you from enjoying the benefit of being less likely to get the flu, all right? So there's a public good. So we got adverse selection, we got moral hazard, we got public goods. And finally, if we think about this, insurance companies are all in the game of managing risk. We spent a lot of time talking about risk, okay? We're not going to be thinking about it from a mathematical standpoint here, But let's think about what health insurance is. Health insurance is a form of spreading risk. You may have remembered from way back when we talked about hedging versus spreading risk. Hedging risk is when you have two assets where one is likely to go up, then the other one would go down. So they're inversely correlated with one another, okay? That is not the case with health insurance. Rather, if one person gets sick, that maybe has a positive bearing on other people getting sick, right? If one person gets sick, people are more likely to get sick, all right? So there's no way to hedge risk, but you can spread it. The best way to spread risk is to have as many customers as possible, okay? If I insure just you as a health insurance company, that is extremely risky, okay? Because you could have a really bad year and I'm going to lose money. But if I insure billions of people, it's unlikely that all would have a bad health year. Some will have a good one, some will have a bad one. I have spread my risk and I can probably turn a profit in that scenario, okay? So what this means is the goal is to have as many customers as possible. Much like your goal in investing is likely to have as many stocks as possible to fully diversify. Health insurance companies have the same basic policy. They want to diversify, okay? You want to not just have females. You don't want to just have males. You want to diversify. You don't want to just have people in the Deep South. You want to have people everywhere to diversify, okay? If there's some sort of pandemic that happens just in Georgia, you don't want to be a health insurance company that just has Georgia customers. This is why we have very few health insurance companies, okay? Because it's hard to be a small health insurance firm. So basically what this means is we have this kind of strange economies of scale. Economies of scale, generally speaking, is defined as a company that has a scenario where when it produces more, when its quantity goes up, its average costs go down, okay? A classic example of this is like a company like a cable company, okay? So let's say Charter. Once Charter Cable has a bunch of wires going throughout Milledgeville, it's really cheap to add one more customer to that line. So the bigger and bigger Charter gets and the more its wires are spread all out over the city, the easier and cheaper it is to add one more customer to that line. To think about it another way, if Charter had just one customer, that would be incredibly expensive for them to have one customer. But if they have 10,000 customers in Milledgeville, adding one more is cheap because they already have the infrastructure in place, okay? So in the case of insurance, all right, when the quantity goes up, so this is specific to insurance, certainly health insurance, okay? When the quantity goes up, the risk goes down. So in a way, if we think of risk as being a cost, their average costs are going down as well. So given that information, all right, what that means is that insurance companies will be huge. There's not going to be 500 different health insurance companies, okay? Because the bigger you are, the easier it is to do. Just like there's not going to be 500 cable companies in Milledgeville, right? There's going to be just one or maybe a couple, right? When it comes to insurance, insurance goods will be huge. What am I talking about here? Insurance firms will be huge, okay? And so the problem we run into there is market power or monopoly power, all right? The problem is when there are few firms, they will charge more and reduce quantity. Okay, we could show this on a graph, but you guys know that this is the case. Okay, you ever gone to a football game and you want to buy a beer? When you're inside the Falcons game, Falcons aren't a good example because they have a very strange pricing model. But let's say you're going to go to a Tennessee Titans game, all right? Because Tennessee Titans, I don't think they do this. If you go to a Tennessee Titans game, the cost of beer is going to be really high. And the reason for that is when you're inside the football stadium, you have no other option for beer. You have to buy a beer at the stadium. You can't just like walk next door because once you're out of the game, you can't come back in. So there's market power. When there's one firm, what they tend to do is charge more, raise the price, and reduce their quantity. So a football stadium is going to have high prices for beer, and the amount of beer they sell is going to be less than it would be in a competitive market. Okay? And so what this means is there's a concern, basically, that consumers are exploited. And what the government will typically do when it comes to such firms is they will try to break them up. And there's been examples of this in the past where there's been companies that got really big and the government has gone in and said, basically, you're too big, you have monopoly power, and then they will force them to break up, okay? So in this case, with the health insurance companies, they could break them up, but this is actually something called a natural monopoly, which means that the monopoly actually should happen because of economies of scale. Right? And when we say natural monopoly, the funny thing is it doesn't have to literally be a monopoly. There still could be 3 or 4 or even 10 firms. But there are fewer firms than there would be in an otherwise similar market, okay, if you didn't have the economies of scale. All right, so the thing about companies that exhibit extreme economies of scale, they actually are a natural monopoly, which means competitively, it makes sense for there to be a monopoly, okay? The same is true for that cable company. It makes sense that that would be a monopoly. The beer inside of the football game, there's no real justification for having a monopoly there, okay? Having more competition would make sense from like an economic standpoint, okay? So, just to go back over what we saw in health insurance, you got adverse selection, moral hazard, externalities, the concern of public goods, and now we're seeing that insurance firms have monopoly power. Basically, every single problem you can have. So what that tells you is the insurance market has a lot of problems. One potential way to fix that is to nationalize it. Let the government take over health insurance. Maybe, maybe not. That's something that a lot of people argue about, okay? Hopefully, if nothing else, this gives you a greater feel for how insurance works. It gave us a chance to review a lot of terms. That's why I left it for the end of the semester. If you didn't notice there, we were calling back on a lot of old material. That's why I wanted to do this near the end of the term. No math, which is good. All right, I don't want to give you guys a bunch of math right at the end or a bunch of graphs. We've had no math, no graphing. So these should be relatively easy concepts for you. See you later.